Welcome to another Market Matters weekly video update. It's Thursday, May 12. I'm Harry Watt, joined by James Gerrish. We're going to talk about some big picture stuff to start with and then drill down into a few company-specific calls we've got at the moment. Big picture, are we bullish or bearish at this juncture, James?
It's been a volatile last couple of weeks in the market. So to put some context into that, the ASX 200 is down around 8%. So we had on the 20th of April, we held high above 7,600. We're now down around 7,000, give or take. So we're down 8%. The US market's fared a little bit worse. So the S&P is down about 12%. From an equivalent high around that same time. So we've outperformed, but we're still down a meaningful way. We wrote in the report this morning, and we have been in the last couple of mornings, about being neutral to market. I'm not a big sitting on the fence sort of guy, but at the moment, I think my bias is more on the bearish side. But I think given where the market has come from and how far it's dropped, it's hard to turn bearish at the lows. So I think if I characterise what our view is at the moment, we're cautious on the market. We've got a bearish tilt. We're not sellers of weakness at the moment. But if the market does bounce from here, which I think there's a good case that it can bounce from here, I think this 7,000 is providing a level of support to the market. So if we see a bounce in the next couple of weeks, we'll then be tweaking our portfolios into a more defensive stance. We've already been doing that, but we'll continue to do that moving forward, Harry, and that may involve also increasing some cash. So neutral here, but with a bearish slant if I look over the next couple of months.
So you talked to moving a little bit more defensive with cash and things like that. How do you play that in terms of volatility and sector allocations of the portfolios?
I think we made some changes to portfolios this week, and it probably speaks to our views around that. So if I take the flagship growth portfolio as an example, we moved out of Virgin. We took a loss on Virgin UK, which was painful. We were up strongly on that position. It's turned around. Its results came through, and the market simply, price action is a really important thing in the market. And at the end of the day, we have views around stocks and positioning the market, but overall price action doesn't lie. So we sold Virgin. It's a riskier type of company. It's a riskier type of stock. It's a cheap, value-orientated company, but it's got risks around it, particularly given its exposure in the UK and Europe. So we took that off. We took a loss on it, but we upweighted our positions in Macquarie, higher quality company. It's also been sold off, and TPG Telecom, which is one of our most recent purchases, and that's a more defensive, earnings stream. It's in turnaround phase. It's got, if I look out to the next 12 to 24 months, they're a self-help story, plus also their earnings are more defensive than, say, Virgin's earnings. So we'd sort of take a position around, I didn't want to increase cash, but we wanted to allocate some more funds into weakness in higher quality companies, and that's what we've done. So that sort of speaks to how we're managing at the moment. So the market's down 8. We're not increasing cash here. We're improving the quality of our holdings. If the market bounces, we'll then probably increase cash, but also continue to work on that, defensive qualities in our portfolios.
We also made a change to the income portfolio yesterday, James. Definitely a more defensive skew in this portfolio. It's been the relative outperformer actually across the suite of the Market Matters portfolios. What are we thinking with the move into the Aussie government bond?
So it speaks to exactly what we just discussed in the flagship growth portfolio. So we sold IVE Group, IGL, which is a smaller integrated marketing business. If you think about one of the mantras I look for or run by in the market is you've got to hope for the best, but also prepare for the worst. So the mandate of that portfolio is all about consistency in income and having lower volatility than the underlying equity market. So if we think about the composition of that portfolio, it's about 70% equities, about 30% in government, in fixed income and cash. So we took one of the equities and sold that, took a profit on that, and allocated it into a government bond, which is now paying above 3% courtesy of rising rates. So that reduces the risk in that portfolio, improves the defensive qualities, so it can continue to offer that consistency. So I think that's one of the main things that I'd stress out there in the market. It's obviously about keeping a cool head as the first thing, but always continually look to improve the quality of your underlying holdings and ensure that the portfolio that you're invested in is best equipped to give you the outcome that you're seeking. So whether that's capital preservation or consistent income, if it's growth, then you've got to be prepared to take some volatility on the nose, and that's what we're seeing at the moment, particularly in those growthier parts of the market.
Yeah, we're going to touch on that next. The emerging companies portfolio has been hit pretty hard lately. That smaller end of the market, the techs and smaller resources even as well. What's sort of our approach now with this portfolio? We did tweak a couple of positions yesterday, James. So where do we see this going from here?
The first thing I'd call out is cash. So in terms of what company balance sheets look like. So, I've been in the markets for nearly 20 years, Harry. I've seen the good times and the bad times. And during the more difficult times, companies find it difficult to raise cash. There was an article in the AFR this morning just about the Expansive IPO. That's a great company that was coming to market. They were talking a $2 billion valuation. They're now talking a $1.2 billion valuation. It speaks to how difficult it is when times change to raise money. So I think we've got in that portfolio, it's obviously had a hard last couple of months. There's no two ways about that. But again, it's improving the quality of the holdings without going and making wholesale changes to the allocations we've got to the market. Raising cash after the market has fallen, in my view, is not the right way to go. It's keeping a cool head and tweaking the portfolio where we can. If there's a position in there, and there was whisper that may in the next 12 to 18 months need cash, then we'll sell that and we'll buy something of higher quality that won't need cash over that time frame. So if you take a level head and just incrementally try to improve the underlying holdings, your underlying exposures, that to me, the market will turn and this will pass and the market volatility will ease again. But whilst volatility is up, that's what you got to do across your portfolios.
Speaking of volatility, how do you keep a cool head in this market, James?
It's a really tough question. I think coming to work every day, looking at the screens every day, that is not conducive to keeping a cool head. I think you got to step back and think about your bigger picture views, and don't try and fight the market too much. So the market at the moment is telling us that the growth is on the nose. I just got off a call with Xero following their full year results. I thought their full year results was good. The stock is down 10%. That is simply a case where the market is shunning growth now. So whether that's right or not, that is here nor there. So the market 6 months ago bid Xero up to nearly $106 a share. It's now below 80, and there's been no change to the business. So that's the market's interpretation or desire to pay for growth. On the call today, they're talking about how much they're going to spend on growth to capture the opportunity they've got ahead of them. The market doesn't like that, and it sells them down. So, look, I'm not here to fight the market. You've got to have some conviction in your views, but also understand that having a high allocation into technology is now going to create more volatility in your portfolio. So I walk away from the call today saying that company is absolutely fine, but the market doesn't like it. We won't go in there and add to that position, but I'll continue to hold that position because I think it's a great company that in a couple of years' time will be at higher multiples than it's trading on now. CSR was an example yesterday. They reported that their results, full year results yesterday. We've seen a number of small incremental broker downgrades today. I'm talking 2 to 4% in terms of price targets and earnings revisions. And most retaining a buy recommendation. The stock drops 8% because of those incremental earnings revisions. So all these things are quite frustrating at the time, but you've got to step back and have some conviction in your views and try and keep a level head that way. But it also comes down to the composition of your portfolio, getting your asset allocation right. So if there's one thing, Harry, I would stress at this stage, when markets are volatile, step back and look at the overall asset allocation in your portfolio. Can you withstand, can you sleep at night? Firstly, if not, then you need to change your asset allocation. So you look at the income portfolio on the website. It's a lower risk portfolio than the growth. The emerging is higher risk than them all. So you've got to have your asset allocation right as the first thing, and that'll help you be able to withstand greater volatility in the market.
Awesome. That's all we've got time for today. Thanks for joining us, James.
Thanks, Harry.
Hope you got something out of this video, and keep an eye out for those Market Matters reports.